Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending July 28th, 2023. Appreciate you all tuning in to this channel as well as our podcast InvestTalk. I'm Justin Klein and today I'm going to title the video Fed raises again, but the BOJ is the main event. And we're going to dig into this. Not a lot of people I think are talking enough about what's happening over in Japan, but there was some big news on Thursday. But I'll show you this. This is just the expectation for a rate pause in September. That's an 80% chance. Anything over 80 is kind of the market fully expecting that. So it's about an 80-20 right now. Obviously, still a good amount of time. We just had a Fed rate hike on Wednesday. So we still have 6 weeks. A lot can happen between then. So certainly a rate hike isn't off the table, but seems like they're now in an every other mode, at least at the bare minimum. But remember, there's only 3 Fed meetings the rest of the year. So not a whole lot for them to probably hike for the rest of the year. So at best, one more. I actually think they're going to pause from here, and I'll talk to you about why. But let's dig into the data. Richmond Fed Manufacturing Index came out -9. What's that? Geez. This has been negative since April of last year. So you're going over a year where the Richmond Fed manufacturing has continued to contract. Same with the Kansas City, down -20, the worst, second worst reading over the past 4 months. And it just shows you that the manufacturing side of the economy continues to weaken. That's what's so interesting is that I've talked about the massive increase in construction spending on manufacturing, right? New manufacturing facilities, onshoring supply chains and manufacturing capabilities. And that's with overall manufacturing shrinking. What happens when manufacturing starts to grow again? I think that's going to be very, very interesting to see what type of a spending area is on that front. Now, home sales, that one ticked down. New single family ticked down. But you can see this is going back 10 years. And pre-pandemic, we were selling in the 600 to 700 range. And that's where we're at now, 600 to 700. So we had a spike up. And it just goes to show you that, home builders were over earning in 2021 and 2022, early 2022. But since then, yes, the activity is pulled back, but it's just back to levels that are still solid, still decent, and that's why the home builders are doing so well because not only are they doing fairly well volume wise, but they're still able to charge relatively high prices because the home prices are high, right? Home prices in the existing market remain elevated because of that low inventory. Now, in the existing home market, pending home sales month over month, that actually ticked up 26 basis points year over year. That still is down 15.6, but you can see it improving, right? The low was all the way down to negative 36% year over year. Now it's down to 15% year over year. So a lot of that is base effects, going back to month over month. It's still overall choppy, but it's one of those indicators that shows you that there's the kind of a new normal that everyone's getting used to within the existing home market. Low inventory, low transaction volume. That means a lot of people within the mortgage industry, within the realtor market, they probably need to go find new jobs because the volume just isn't there to support all those people that had been doing pretty well post-pandemic. Now, real GDP came in for the second quarter. I always say it's overhyped. This is the second quarter. Hey, guess what? We're just getting through the first month of the third quarter. The third quarter is a third over. So this is very backwards looking. Now, it was better than expected, but it just goes to show you that overall the economy, while anything interest rate sensitive is not doing very well, there are large parts of the economy that remain relatively robust, and unemployment remains very low, which we've talked about. And it's hard to have a major recession when most people have jobs, right? Durable goods new orders, excluding defense, that was up 6%, excluding transportation, that was up 0.6%. So overall, durable goods solid. Nothing really to write home there. US PCE, this is something that the Fed looks at a lot, down to just under 3%, right with the CPI. And consumer sentiment, that was up to about 71, the highest level since, let's see, going back to, since October of 2021. Can you believe that? Nearly 2 years, highest level in nearly 2 years. So wanted to highlight that. Now, next I'm going to pivot over to the charts, and we're going to look at the yen. And this was the move on Thursday, that reversal. And it was really about the news out of the Nikkei. Nikkei is kind of the Reuters of Japan. And what did they say? Well, they said that they're talking about, the Bank of Japan is talking about getting off the zero bound of negative 0.1% on their version of the Fed funds rate and bringing it up to 50 basis points. And why? Because inflation is now above 3%, right around 3%, which for them, is elevated, especially, I think we had disinflation pre-pandemic, going back a decade plus. They had it even worse. They had a lot of deflation in many cases. So they're doing everything they can to bring inflation, and now they're getting it. And so interesting little move. The next day, we did get a pullback on the yen after that, but we didn't break below Thursday's lows. So that'll be interesting to watch to see how that evolves. 'Cause remember that the yen, the Bank of Japan is one of the largest buyers of U.S. Treasuries. And that's why if you go to the 10-year rates pushed strongly higher and really paused. And so is this a catalyst for a breakout? I think that's certainly possible. Also, they talked about the TGA, Treasury General Account, being refilled and that pulling liquidity out of the market, right? The Treasury issuing debt, and then that is pulling dollars and risk out of the market. And that hasn't happened so far, mainly because the Treasury is issuing short-term securities, which are very, very low risk, very low duration risk, very low credit risk. And so there hasn't been a reshuffling broadly on risk. And you can see that with let me pull this up. Having trouble typing. There we go. You had this reversal. That reversal on Thursday was fairly significant, pretty good volume. Overall for the week, we had a pause to slightly higher on the S&P. I'll be watching to see, do we get above Thursday's highs or below Thursday's highs? You're in this little micro pattern right now to see what is going to happen with the equity markets and that follow through or complete reversal of that Thursday's move, because Thursday's move was fairly significant. Okay, so I'll be watching that. The move index, that one hasn't really moved. It still remains but around the 100 level, which is just fine. No real problems there that you really have to worry about. Let's look at commodities. Commodities continue to remain strong. This is just a bullish consolidation right at the 200-day moving average. So I see no issues there. Oil had some strength this week, and you had the XLE very strong. That one's just consolidating. And then let's look at the IWF to the Von V. We know that we had that reversal of the growth stocks versus value. Pretty nice move on Friday, but still, this is looking like it wants to roll over. Look at the MACD here. So we'll see if we can get below that 50-day moving average. I think that would be a big tell as well going into next week. What else do we want to look at? We want to look at the credit markets. So junk bonds to short-term treasuries. And you saw that reversal, see that big reversal on Thursday. That's a manifestation of the worries that are coming out of the Bank of Japan, or the actions by the Bank of Japan that could pull liquidity out of the market. So something that you want to keep an eye on to see if the credit markets also move. That's what I'll be watching next week. Commercial mortgage-backed securities. Let's see if that had any move. We talked a lot about, and there's a lot of news about the commercial real estate market, and obviously that one is not rolling over. Okay, so we don't have to worry too much about that as of now. The industrial side of the market, that one remains relatively strong. Let's look at tech. Tech you're starting to see this roll, right? You're starting to see this is that overall weakness, that drop here, the MACD is weakening. It's still overall an uptrend, but micro trends are starting to emerge that this momentum is weakening. And you can see with some of the earnings announcements, Google was probably the strongest. Meta was also up, but it did fade that day, closed right near the previous highs on Friday. So we'll see what kind of follow through we get from Meta, but that fade on Thursday was of note. You had Netflix, their earnings reaction continues to be poor and fall through to the downside. Um, Apple, I believe Apple is next week, so I don't think we have any data on an Apple quite yet. Let me clean this up here. And that's something I'll be watching as well. The dollar, that one uh, did have a move higher, and we're now in this, I think, choppy period. We made a higher low. That's interesting. 3 higher lows, but we do have a lower high. So what do we get here? Do we get a breakout to the upside or to the downside? That's something I'll be watching to see what liquidity is telling us in the market. Overall, I do think that we are going to probably see some more volatility in the back half of the year. We had the Fed or the banking crisis in the first quarter. The second quarter was very strong, and a lot of this was in the midst of pretty strong liquidity. I expect the liquidity dynamics to not be as robust in the second half. And so I expect a more choppy, not necessarily bad. We can still have a certainly up second half of the year, a positive second half of the year. But I think this is a period where you're probably going to get more volatility than you have seen, especially over the past few months. So um, the VIX, remains low, looking like it wants to move higher, but that might not happen until the middle of August. And that's probably where I would say I'm expecting the next bout of potential volatility in the back half of August. And that would start the choppiness that I expect for the back half of the year. Still opportunities. The industrial space remains relatively strong, which we just showed, and the cyclical parts of the market are looking better. Energy, industrials. Let's look at basic materials. That starting to gain some strength as well on the weaker dollar. So overall, I'm still, I would say, neutral to modestly positive on the back half of the year, but also depends on the sector and the slice of the market that you're speaking of. Interest rates will be a big factor, whether they break out to the upside or the downside. Here's a 10-year. We're still in this choppy range. Do we get a breakout to the upside on the Bank of Japan news, or do we get a move to the downside on the economy weakening potentially in the back half of the year due to student loan debt repayment starting? I believe that's in October, end of September. And I do expect that, but which one will win out? My guess is we actually probably break to the upside if I'm going to take one bet or another. So that's my take on the markets for right now. Short term, probably modestly positive. Over the next 2-3 months, probably slightly negative, but for the back half of the year, mostly positive. All right. Well, I think that does it. Appreciate you all tuning in to this channel. I hope you have a wonderful weekend. And a reminder, the contents of this video are for educational purposes only. Should not be construed as a recommendation to buy or sell security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a great weekend.